Bunzl, FTSE 100 distribution business of, I believe, what they call non-food consumables, which makes it sound like things you don't eat, or things that you eat, sorry, but are not good for you in a certain way. But it's not that. It's things like plastic bags and disposable cutlery and packaging and that kind of thing. They have released their preliminary results for the year 2024 because they're UK companies and we are not so forward looking as that. And their year actually ends roughly at the end of 2024 as well, which is kind of nice. So, revenues, the market, by the way, sent this stock down quite a bit, and there's a bit of a theme to a couple of mine here. Revenues for the year grew 3.1%, and they said this is mostly the result of acquisition. To be honest, underlying, as they call it, so organic, revenues actually declined by 2.4%, combination of deflationary pricing, i.e. price cutting and competition elsewhere, and just weak demand from the US in particular, where they do a fair bit of business like nearly everybody does. Operating income for the year was 873 million, which was up 2%, 6% if you consider it in constant currency, which don't mind if you want to or not. And EPS, or basic EPS, was 149.6, which was down 4.8%. Adjusted EPS, to make it look better, was 194.3 pence, which was up 1.7%. I mean, one of the reasons that their basic EPS was down so much was they sold off their Argentina business. And when you sell off a massive lump of your business, you expect things to kind of go away a bit. So in basic, it's not GAAP, it's IFRS terms, you get a PE ratio of about 22. On an adjusted basis, it looks more like 16. I think it's quite a big difference between those two numbers in the context of Bunzl, to be honest. And in terms of free cash flow, it looks a lot more like the 16 than it does about the 22. Anyway, the dividend. So the stock fell 7% or so on this. I wasn't entirely convinced that was justified. However, what I will say is when I saw their Q4 results, which are mostly, you can read the end of year off the Q4 results in a lot of cases. They gave you a sales update for Q4 back in December. It went up quite a bit, and I didn't think that was the right thing either, to be honest. So I think this is roughly now back where I thought it ought to have been. But anyway, the dividend, which is the thing, of course, we all care about in the UK with growth stocks, that's up again. They're a dividend something or other with loads and loads of years of consecutive increases. I'm not going to say dividend aristocrat, by the way, Steve, because I found out this year that is in fact trademarked. Or not this year, this week. That is in fact trademarked by S&P. So all these people who are sticking dividend aristocrat in their YouTube videos and so on, get ready for a message from S&P's lawyers, which who have been getting active recently. Anyway, this dividend winner is hiked again, and they have pushed their dividend up by 8.4%, which is not actually nothing. I mean, sometimes you sort of see things creeping them up by 1% or a fraction of 1% or whatever to try and keep the dividend going. 8.4% is a genuine raise. It's not a massive yield, but that's because of where the share price is at the moment. So it takes you to about 2.5%. There's another sort of 2.2-ish% to come from buybacks on about the same amount here. So 4.75% total kind of return coming back your way. And that's kind of free cash. But here's the general outlook for Bunzl. They have committed to using £700 million per year. More on that in a moment, which is about 7% of their market cap for acquisitions to boost growth. And they say if they can't find these acquisitions, they're going to return the cash via dividends and share buybacks. And that's a kind of interesting thing to think about here, I think, because it's not coming through debt to start off with. It's not coming through equity raises. They make 634 in free cash in the year just gone. So you're looking at most of this coming through cash generated by the business here. And they say we're either going to use it to acquire things or we're going to give it back by dividends or share buybacks. I think this is kind of interesting because a lot of people are suspicious, and I understand why, of growth by acquisition as opposed to organic growth. But there are a couple of things to note here. If you said you're going to get a 7% yield off this company and they're just going to dividend the whole thing out to you, you would view this straightforwardly as probably about right for a dividend stock. You can find REITs that are trading at about that level and not going to grow a massive amount, but you can reinvest and compound at 7% and the share count isn't going to grow, which it does with most REITs actually. But you'd say that was pretty good buy. The fact that they're going to try and invest some of it to make the thing grow a bit bigger suddenly makes it look less attractive to people, which I think is interesting and probably a mistake. It depends on them investing this well. But if you think their hurdle rate then is about 7%, which is what they're yielding for the moment, their returns on invested capital since 2019 have been 13.6%, 16.2%, 15.1%, 15.0%, 15.5%, down this year to 14.8%. Point is, they are good at getting a better than 7% return on their stuff they do through acquisitions. Nothing's guaranteed. They could screw it up in the future. It's within the bounds of what's possible. I would say better investors than the guys running Bunzl have historically made the odd investment mistake. It is almost inevitable. But what I would say is they've done a very good job with what they have there. And if I were thinking of this as a business owner, would I be saying, no, give me the cash back and I'll find something better to do than 14.8% return on an investment? I'm not sure I would, Steve. I'd be saying, I think if I think you can hold at 15% or so return on invested capital, keep all the damn money and go and find something to do with it. I'll take the stuff you can't use, but by all means, go keep it and reinvest it. What do you think?
Yeah, it's still this 700 million that they've sort of promised. It also seems to be kind of like a bottom, the bottom offering that they're offering here, because in the last year they did 883 million worth of acquisitions, 13 record spend, but they're also in the process of doing a 200 million pound buyback as well. Looks like they've done 50 million of it, with an additional 150 to either be completed or has been completed recently. So they've committed a fair amount of cash just in those two bits. To either grow or return to shareholders. So yeah, it looks pretty interesting, Stevie. I think the issue we have with it is the issue that people have with all of these acquirers is you have to kind of do the legwork to get the valuation correct. If you permanently removing 800 million off the, or 700 million off the earnings, everything's going to look really expensive, rather quickly. And not all of those acquisitions are going to come off and be amazing companies, but this company, like almost all of our sort of roll-up companies that we cover, Steve, have got a really, really good track record of at least being able to beat the rate of return to shareholders, which is exactly what you want from these kind of companies. They are run pretty much for shareholders. I think the people who run them must have decent stakes in them as well, so their money is on the line as well, and they tend to do a really good job rolling up these companies and then sending the cash out to shareholders when they can no longer find anything else worth acquiring. But I think the only thing people probably don't like about these companies is, I would imagine they're the sort of company, Steve, that if they came across an acquisition that would swallow up the dividend and swallow up the buyback, but it was a very attractive company that they thought could, make all the difference to them, they would cancel that dividend, they would cancel that buyback, they would buy that company, and they would say to the shareholders, suck it up. It's going to be, this is going to be, value accretive to us over the long run. And I would imagine they haven't done that yet. I did the maths for you, Steve. 32 years of consecutive annual dividend growth makes them a dividend winner, as we will go with. And I mean, is this in your portfolio now, Steve? Have you bought this one yet, or is it on the hit list still?
In my GIA, or the invest side of my trading 212 account, I have thrown about 150 quid at this one. So the answer is it's barely in my portfolio, but strictly, if I write about this, it comes up on a disclosure to say, yes, I do own it. I'll tell you who else has bought it, though. Frank Van Zanten has bought it, and if you don't know who that is, he's the CEO. I thought I'd seen an insider buying alert recently. He has, on the 6th, which is yesterday as we record this, bought a total of, 4,000 shares for 121,480. So he's bought about 1,000 times as many shares as I have. However, I generally see insider buying, especially from a CEO, as a sign of confidence. And I was just scrolling down this thing that I'm looking at here, and I note that about this time last year, actually about a month after this time last year, he sold 24,000 shares for an awful lot more money than this. But insider buying is always a nice thing to kind of see on these things, Steve.
Yeah, take it from Bill Lenehan. He said, if you want to know when I think Four Corners Property Trust is too expensive, he said, I'll be selling it. And if you want to know when I think Four Corners Property Trust is of good value, I'll be buying it. Because he said to be completely frank, Four Corners to him is an investment as much as it's a business that he runs. When he's buying the shares, it's an investment in the company, and nothing other than that. So yes, I think that's kind of what you would look at when you look at most companies like this of this kind of ilk, REITs especially. I would say honest REITs if you trust the management to be honest about it. But yes, same with the roll ups as well, Steve, because that's all they're doing really. They're an investment team investing in businesses, sitting back in the leather chair looking for the next one.
Yeah, rather see it that way round than the other way, I guess. You've been watching a segment from the Playing FTSE show, brought to you in association with our favourite broker, Trading 212. For the full version of the show, check us out on Spotify, Apple, or wherever you get your podcasts. And if you open a new account with Trading 212 using the link in the description, there's a free fractional share in it for you. Just make sure that you use the code FTSE when you sign up. Terms and conditions apply, and do remember that when investing, your capital is at risk.